Well, hello, welcome to Passive Wealth for High Tech Minds podcast. There are lots and lots of IT professionals who work in the industry. These IT jobs are so exhausting mentally, there isn't much time left for such folks to make clever decisions about their investments. Most are unable to put their money in the right asset classes. This is Prashant Kumar from Realty Gains. I have worked in corporate America in IT and in business organizations for 25 years. My goal is to educate IT professionals like you about the benefits of passive investing. I will be passing my knowledge and will bring guests who have done very well in their careers and can explain the process and advantages of passive investing. So, let's begin. I want to impart all the knowledge I can about risk mitigation in commercial real estate investing. So I want to kind of give a background. Everybody talks about risks. What are the real risks in real estate investing? There are many risks in real estate investing. One could be bad location. Second is negative cash flow, possible negative cash flow, huge vacancies, problem tenants, right? And on top of it, in a commercial real estate, you may have risks like if you have a single tenant property, that is the most risky property, or single use building like an auto dealership, that could be a very risky proposition, because if the dealership guys move out, you are stuck with that commercial property for a long time, right? Trying to re-rent it or try to rehab it to suit to another tenant. In addition to that, there are many disadvantages also in the real estate investing. Number one is obviously it's a long-term investment. Money is not liquid. Your real estate properties need maintenance. There could potentially be rent controls in New York City. Like in New York City, we have rent controls. You cannot just raise the rents depending upon your wish, right? When you have real estate, it requires time. And of course, transaction costs are a little bit higher, right? So again, for commercial properties, increase in vacancy, complicated lease terms. We have complicated lease terms in retails. We have, other disadvantages like you have upfront capital required and reduced capital growth. So there are many disadvantages. Physical risk is always there, hail, rain, thunderstorm. You have tenant risk, you have market condition risk. So I'm going to talk about what do we do, right? What do we do in terms of taking care of those risks? The biggest risk is folks think about recession is coming. So let's talk about one by one, okay? When I say vacancy risk or negative cash flow or bad location, we at My Realty Gains, we invest in properties which are in good locations, right? They are not C minus or D class assets. They are typically C plus, B minus, A class assets in good locations. So it is basically, we as passive investors have to look for sponsors who invest in a good quality asset, right? You as investor, or we as investor, invest in these assets only when we know the sponsor is able to take care of those assets. Sponsor is the one who is professional to do the job. They know even if there's a negative cash flow on the property, they know that they can turn around, they can remove the problem tenants and improve the cash situation on the property, decrease the vacancy by putting right kind of tenants in the property. In multifamily and in assisted living or storages or mobile home park, these are not single tenant properties. Even if one or two tenants move out, that doesn't really matter, right? I mean, unlike single use commercial assets. So assets which have huge tenant base are better than single tenant properties. Even if one guy leaves out of 100 units, it's not going to affect the cash flow anyway too much, because you have already underwritten that vacancy, 10% vacancy in your underwriting, right? So that risk is mitigated. Yes, your money is locked for a long time in the deal, but it is cash flowing from day one. We buy apartment complex, which is cash flowing from day one, so that you give returns to investors. So somebody buying the property themselves and managing it, meaning that it is dependent on their individual skills and contacts in the market. But somebody investing with a sponsor who is professional and has far larger outreach in terms of contacts, in terms of trying to maintain the property, we as investors end up making more if we invest with a seasoned operator. I'm 100% sure that we managing the asset ourselves as an investor, we will end up making mistakes, and those mistakes are pretty expensive. Those mistakes are pretty expensive. So better let those things be handled by a seasoned operator. In addition to that, as I mentioned earlier, complicated lease process. If you are in retail, lease process is very complicated, but in multifamily or in storages, lease process is pretty simple. It's just renting an apartment. Upfront capital is high, obviously, but it comes from a lot of investors. Investors own part of the property, and they get part of the rent. Basically, investors own part of the property and they get part of the rent. Tenants are not giving them the rent directly, but investors are getting it anyway. So the tenant risk is minimal. If you have 100 people, 1 or 2 tenants are bad, which is okay. We evict them. That's our job. Basically, seasoned operator doesn't get worried about those things. These things are management intensive, so that real property managers take care of those big assets. It's not being handled by mom and pop folks. It is handled by real professional folks. So there are advantages of investing into multi-tenant based assets, which are sort of recession proof in a way. The biggest challenge that people have been thinking that recession is coming, what to do. If you really, really think about it, recession will come. What will happen? Maybe some offices will get closed. Maybe some people will lose job. If that happens, what will happen? People will downgrade their houses. They will sell their houses. They will move to apartments. They'll move their stuff to storages, right? So these are multi-tenant. I mean, are people going to leave their apartments and go somewhere else? I don't think so. I mean, folks need place to live. So your occupancy in recession actually goes high on some of these multi-tenant assets like multifamily, storage, or mobile home parks. And even in assisted living also, the occupancy, in my mind, it goes high because, for obvious reasons, we are aging every day. 10,000 baby boomers are aging, coming to the retirement age every day. So these are some of the asset classes which are not affected by recession. Recession is coming. Yes, you may not be able to exit a property. Property may not have, there may not be buyers in the market for those assets, but you will be able to get the cash flow out of it. I want to emphasize it. You will be able to get the regular cash flow out of your deal on a regular basis, even during recession, because I have not seen in an emerging market, I have not seen rents going down even during recessions. If you find a place in the middle of nowhere, there potentially investors, rents may go down, but not in an emerging market. If there is a population growth in a market, rents can never go down. Okay. So just wanted to clarify some of these points. What are the risks in commercial real estate and what are their mitigation if we invest into high tenant, multiple tenant asset classes. This is Prashant Kumar. Until next time, goodbye. Thank you so much for listening to our podcast. As usual, you can reach me via my website, www.myrealtygains.com, and via email, prashant@myrealtygains.com. I would love to hear from you and talk to you about specific needs you may have. Please schedule an appointment with me via my website, again, www.myrealtygains.com. Stay tuned for next podcast. This is Prashant Kumar signing off for today.